The global oil market is experiencing a dramatic shift, with inventories swelling to multi-year highs and prices tumbling sharply. From $82 per barrel in January, crude oil prices have now dropped to around $60, a nearly 21% decline in just 5 months. This steep fall reflects not just routine market fluctuations, but deeper concerns about a growing supply-demand imbalance that could destabilize energy markets well into the future. A perfect storm. Supply surges, demand wavers. The current oversupply is being driven by a confluence of factors. Major oil producers, including the United States, Brazil, and members of OPEC, have ramped up output, seeking to capitalize on previously high prices and meet anticipated post-pandemic demand. However, global consumption hasn't kept pace. In particular, weak industrial data out of Europe, stagnant growth in emerging markets, and lingering inflation concerns have subdued oil demand growth. Even the United States, traditionally the world's top oil consumer, is seeing softer than expected fuel consumption, partly due to a shift toward electric vehicles and increased energy efficiency in the transportation sector. Most striking, however, is the role of China. The world's largest oil importer has accumulated record onshore oil stockpiles, signaling either strategic stockpiling or lagging domestic consumption, or both. According to shipping data and satellite imagery, China's commercial and strategic reserves are now at their highest levels since reliable tracking began. China is sitting on a mountain of oil, said Sarah Koenig, an energy analyst at PetroView. They've been buying aggressively, possibly hedging against future price spikes or geopolitical risks. But it also raises the question, what if they're not using as much as they anticipated? The economic warning sign, falling oil prices are typically welcomed by the consumers, offering relief at the gas pump and lowering transportation and production costs. However, when those declines are driven by weak demand or unchecked oversupply, they can indicate broader economic stress. This kind of price drop isn't just about cheaper fuel, noted Marcus L. Amin, a senior economist at the International Energy Forum. It's a red flag that global economic momentum is slowing, and markets are pricing that in. Indeed, energy markets often serve as a leading indicator for the health of the global economy. A prolonged slump in prices may hint at stagnation in sectors like manufacturing, logistics, and travel, which are closely tied to oil demand. A stability crisis in the making. Beyond economic implications, the oversupply threatens the delicate balance that oil producers have tried to maintain in recent years. OPEC Plus, the alliance of oil exporting countries, has historically tried to manage output through coordinated cuts. But with some members unwilling or unable to rein in production, tensions within the group are growing. Moreover, non-OPEC producers such as the US and Canada have little incentive to restrict supply, especially with advanced shale operations continuing to produce at competitive cost levels. Without coordinated discipline, we could be headed for a prolonged period of price instability, warned Koenig. And that's bad news for everyone, from oil companies to governments that depend on petrodollars to fund their budgets. What comes next? Analysts are divided on how the market will respond in the second half of the year. Some expect a correction as producers cut back in response to falling prices. Others believe the oversupply could persist, especially if economic conditions continue to deteriorate, or geopolitical uncertainties, such as conflicts in the Middle East, do not escalate further to disrupt supply. For now, the situation serves as a reminder of how volatile and interdependent the global oil market remains. Investors, consumers, and policymakers alike will be watching closely to see whether this is a temporary dip or the beginning of a much larger energy reset.